some people say, and they say it right, save the best for last. And that is exactly what we have done. So let me now invite, without further ado, the Managing Director of Metals Focus, Mr. Philip Newman, the founding partner of Metals Focus with almost 3 decades years experience. Prior to this, Philip was a research director at GFMS, where he was a key contributor and project manager of silver, gold and PGM surveys, research reports and consultancy projects. And ladies and gentlemen, here he is sharing his brilliant mind with you all. Let's give him a round of applause.
Pleasure to be here this afternoon. I realise I'm standing between you and the start of this evening's entertainment. So hopefully I'll keep you enthralled for a few minutes. So what I want to do over the next few minutes is share with you Metals Focus view for the gold price over the next year or so. For the few of you who may not know about Metals Focus, just very quickly, we're an independent precious metals research company, a team of about 30 in 8 markets. Including my 4 colleagues here based out of the Mumbai office as well. And our reports, some of these you'll see up here, and our gold focus is also in the delegates bag as well. We also produce short and long dated forecasts and work on the doré market as well. Anyway, without further ado, in terms of looking at the outlook for the gold price, first of all, a chart that will be familiar to many of you, looking at the gold price against the trade-weighted dollar on an inverted basis. And you can see most recently, we think about 2022 and 23, but especially for 2022, how initially, of course, we had that positive reaction for the gold price after the invasion of Ukraine, but then quite tellingly, we saw the gold price in dollar terms weaken through to November before it has recovered and recovered quite well for this year. And even though the gold price is flirting now with the $1,900 level, on Friday, of course, it dipped below that point. From our point of view, and hopefully you'll agree, this is still an exceptionally strong price, however you look at it. At the same time, though, we are very much seeing mixed indicators in terms of how investors are behaving, which for me personally is quite a surprise. And we see that on this chart as well. So here, the black line is showing the trend in global gold exchange-traded products, ETPs. And of course, you can see again the positive reaction in terms of inflows after the invasion of Ukraine. But I think what's quite telling is how those holdings have weakened, drifted lower pretty much since then. When we look at the red line, that's showing you net positions on the CME in New York. And again, you can see how they have drifted lower, except of course, most recently, how we have seen that positive reaction. But again, I think it's really quite fascinating. With a gold price of $1,900, I would have expected these to be moving in a sort of a uniform direction in an upwards trend, and we're clearly not seeing that. Before we look at some of the reasons for that, and therefore what that means for our outlook for the gold price, just a quick closer look in terms of the ETF space. And just on the right-hand side, where you can see those orange bars below the line, that's showing you the liquidations that we've seen in Europe. And the reason I put this chart on is that we are seeing echoes of that in the coin and bar market as well, and especially in Europe, where we've seen net buying or gross buying weaken. We've seen liquidations pick up, not just in Germany, which is by far the biggest coin and bar market for gold in Europe, but across many other locations on the continent as well. So again, just to reiterate, we are certainly seeing a mixed picture when it comes to some of the investments that we're seeing in the gold market. And I think one of the reasons for that is how investors are looking at how the Fed is behaving, and more importantly, expectations of the Fed. And to manifest that and to understand that, of course, they're interpreting how economic data is performing. And one of the things that we're seeing, of course, and most recently, I think this is one of the headwinds that has driven gold lower, is that pick up in US Treasury yields. And you can see that from the red line at the top. And I think this is certainly an important headwind for many investors that can, for example, invest risk-free in more than at least a year, earning over 4%, rather than having to be concerned about owning gold and the risks perhaps associated with that. And again, when it comes to how investors are perceiving the Fed, as I mentioned, they are looking at some of the core data that's coming out. And does this mean that the Fed will maintain its position of having rates higher for longer? Or will the US rate or information that's coming out encourage the Fed to adopt a more dovish stance? And I think at the moment, given that gold is still holding at around the $1,900 level, there is still quite a separation between what the Fed is saying on the one hand and what markets are expecting the Fed to do. And that's in spite of information that we can see on the screen. So we can see from the blue line, which is the US core inflation, so excluding food and energy, this is something that the Fed looks at very closely. And even though we've had super core inflation, as it's called, falling, which excludes housing, you can see that ultimately, yes, they've come down, or super core has come down, but core inflation is still exceptionally sticky. And as you can see, that is still well above the Fed's target of 2%. Another indicator, which I think is being very closely watched, is how tight the labor market is. And you can see here that at the moment, there are 1.5 openings for every unemployed worker. And of course, putting the COVID spike, you can see there, the pandemic, the US labor market remains exceptionally tight. And so I think from our point of view, this is a very useful indicator for really helping to reinforce the position that the Fed has put out there, and consistently so, again, that it will maintain rates high for longer, and therefore it will postpone either when it starts to cut interest rates, and when it starts to cut interest rates, the frequency will be less than markets expect. Something else which perhaps backs up that view is how GDP is performing in the States. So the blue line is actual US GDP. But what we're seeing is the leading indicator by the yellow line, which is a metric which has been created by the Atlanta Fed. So this is not a forecast necessarily of US GDP. This measure, basically what they do is they feed in the latest economic data into this. So this is suggestive of where US GDP will be. And in fact, the latest data, which came out on Friday, suggests that Q3 GDP in the States will actually be 5.8%. Quite a dramatic figure. Now, I think even if we don't see US GDP get up to that level in Q3, this certainly suggests that we're not seeing a faltering or a change in the path of US GDP. So that upside is being cemented. And again, this is cementing the scenario of the US economy being quite tight, being very strong. And again, this just reinforces the view that the Fed is not about to adopt that dovish stance. In spite of all of that, the probability that the US will fall into recession is still exceptionally high among the banking community, among investors. And a key reason for that is the view that it can take 6 to 9 months for the tightening of US rates, or for any interest rates, to feed through into the real economy. So in spite of those metrics I've just shown you about how tight the market is, how strong GDP is, this is an important indicator, again, why you have that separation between what the Fed is saying on the one hand and what the markets are expecting, and therefore, I think an important indicator why the gold price is staying so high. But it's not all about all of this. So what I wanted to do as a last macro slide is really show you, when you bring all of that together, what that means for US interest rates. And so the red line you can see there is from the FOMC dot plot in June, which suggests that by the end of next year, US rates will be 4.6%. However, the market still expects there'll be more cuts than that, shown by the yellow bars, 5 cuts between now and the end of 24. And so the market is expecting that rates will be 4.1%. So again, we still have that separation. The other point I think is worth noting is that when we're thinking about the outlook, metals focus for the gold price, it's not just about the macro backdrop, we're also looking at supply and demand for gold. And on the next couple of slides, I want to focus on the demand side. Now, those of you that attended our Mumbai gold launch of the Gold Focus in June, which Chirag and Harshal hosted, will have seen this slide, but it's quite an important one. I wanted to put it on again. So just to explain it, if you're not familiar with this waterfall, we have global demand in 2021 on the left-hand side, 22 on the right-hand side of 4,800 tons. And the most important reason for that increase is that rise in central bank net demand of 633 tons. So just to be clear, the 633 is not the totality of central bank demand. It's the increase we saw between 21 and 22, but it did drive the total to a record high of around 1,100 tons. And the buying that we saw last year, also much of that was concentrated in the second half of last year. And if you remember one of my early charts where I showed the gold price drifting lower through to November, this was absolutely pivotal in helping to provide a floor to the gold price. And I think what's really interesting when we look at the interplay between supply, demand, and the price, when we look at, say, the official sector or physical investment, which is our coin and bar category, rarely will this drive the gold price higher, but it can be absolutely fundamental in helping to solidify that floor in the market. And in the case of the official sector, very much so. For physical investment, even though you only see a 34-ton rise between 21 and 22, that shouldn't detract for how important the absolute total was last year. We saw eye-watering levels of demand in the likes of Europe. The US was also exceptionally strong, to name but a couple of markets. The Middle East was also very strong as well. So these elements were certainly helping to provide a floor, and especially the official sector. It's difficult to quantify how important it was, but I would say very conservatively, it would have at least added $100 to the price. In other words, if we didn't see that central bank demand concentrated in the second half of last year, you could very well have seen the gold price at least $100 lower in the back end of last year. So where do we see the market this year? So we are seeing, as you can see, the official sector, an expected drop of 483 tons. Now, I guess in isolation, that may appear quite bearish, but there's a couple of things. Firstly, 2022 was a record high total, so I think it's unfair to use that as a benchmark when we're thinking about the market this year. The other thing that's really important is that we saw selling by central banks rise, or has already risen this year, the likes of Kazakhstan, Uzbekistan, and especially Turkey. If you know much about the Turkish market, in the run-up to their elections, the government banned imports of gold, trying to support the Turkish lira, and so the Central Bank of Turkey was releasing gold into the local market. And over the first 4 or 5 months of this year, the amount of selling we saw was more than all of last year. So in spite of that high level of selling, the total this year we're forecasting is about 750 tons of gold buying by the central banks on a net basis. So again, that will still be an historically high total. And so that is still helping to provide some support to the gold price. But ultimately, from our point of view, when we think about the interplay of demand with the macro backdrop, we do believe that the Fed will hold course, that it will maintain rates higher for longer. It will risk the potential for a recession, although in our view, we believe the US economy will, in a sense, have a slow economic landing. But as the markets move further towards the Fed's position, away from their dovish stance to the Fed's more hawkish stance, we believe there will be liquidations in the market modestly this year and perhaps gathering pace next year. And that's why, in terms of the gold price, we believe that there will be some weakness. But even this year, with the weakness we expect over the next quarter or so, before the end of the year, we still think the annual average will hit a new high of $1,900. Not too shabby at all. But we do believe those liquidations will continue into 2024. Of course, it won't be one way. There will certainly be many investors that will take that as a signal to enter the market. There'll be bargain hunting as well. But ultimately, we do believe that there will be a weaker tone to gold prices next year. And on that slightly less bullish tone, that concludes my comments. Happy to take questions either now or during this evening's entertainment.
Thank you, Philip. This is Sony from ANZ. Short term, yes, very well resonate with your view that we are having things are turning differently in terms of economic scenario, because now recession is shifted, especially US recession is shifted to 2024. So we are not seeing Fed is becoming hawkish and inflation is easing. So that is going to have impact on real yields, where, that will be negative for gold prices. And USD, it has, upside risk for USD as well in the short term. But what about the long term, where, where Fed will start pausing its interest rate, and maybe because now the interest rate in US is going to be 5.5, which is very high, and this will have some economic implication, and they have to think about, economic slowdown. So at some point of time, they are going to pause the interest rate, and by mid like next year, what's our view is they can go for a rate cut as well. So in that scenario, maybe that will be a pivotal point for the gold, where we'll see, its investment demand start coming in. And the other factor could be US dollar, which is, volatile in recent months, I would say, because of the shifting expectation around macroeconomic environment. But we feel it's still in, downward trend, and it will continue. So what's your view on these factors? Is it going to continue till next year? Because that's what your forecast is showing. So just a brief comment on these factors.
Sure. You covered quite a lot there. I'll unpick a couple of them. So we do believe, yes, the Fed will cut rates next year, but the point of when it starts cutting and the frequency of cuts will be less than the market currently expects. So it will, yes, start to adopt a dovish tone as we move through 24 and into 25. Of course, the expectation is that it will do so having contained both inflation and obviously inflationary expectations. And so as we move through, next year and the economy starts to strengthen, and we see equities start to rise, that will be an interesting dynamic, because you'll see some investors, of course, rotating out of gold if the equities are doing well. You'll have other investors that believe in gold, because after all, even last year, when when gold's intra-year didn't do a great deal, it still outperformed many other asset classes. And so, I think many institutional investors recognize that. So I think you will have other investors, as equities strengthen, they'll want to, for example, whatever their allocation is, 4 or 5%, whatever it may be, we could see them wanting to retain their allocation to gold. So I think there'll be a lot of sort of two-way activity. And of course, with rates coming down, that will obviously be less of a headwind. That could obviously undermine the dollar to some extent. Maybe there'll be less safe haven requirement for dollars as well, which could also, again, weigh on the dollar and could be gold supportive. But we think we could be in for, a couple of years of weaker prices. But ultimately, as I said, even though the investment that we've seen now has been quite mixed. You know, when we speak to institutions that are selling to asset allocators or wealth management funds or the high net worth, it does seem quite mixed. But again, I shouldn't detract from, I think, their view of how well gold has performed, especially last year. And I don't think that's shaken the belief. It just could be, I think, a delay before they are actively coming back into the market. We'll be happy to sell you our 5-year as well to go further out.
Yeah, thank you.
Just one quick question, and this is relevant to gold prices denominated in the Indian rupee, right? What's the perspective on the gold to oil ratio?
On the
Gold to oil ratio, I mean, you've seen the Fed becoming dovish. The market's assuming the Fed's becoming dovish. But do you kind of have a sense on where oil is going to be vis-a-vis gold? Because what that does is, given that we're a hydrocarbon economy,
yes,
even though international gold prices may come down,
yes,
but if the dollar rupee depreciates, it kind of gives a very strong floor to domestic prices in India. So what's the kind of assessment of where oil prices could be in relation to gold internationally?
Okay. Well, as a research house, we spend all our time focusing on forecasting pressures rather than oil. But so I need to come back to you on that one specifically.
Yeah.
But of course, I think you would generally expect, as the global economy starts to gradually strengthen from the back end of 24 into 25, as China emerges from its deflationary environment it has. What are we expecting with, in terms of Russia and Ukraine? Obviously, we're not going to have that oil necessarily released into the West, because these countries, the West or especially Europe, is obviously moving away from being reliant on Russia. So I think that could maybe, offset some of the upside we see in the oil price. If you want something more specific, I'll put you in touch with my colleague Harshal,
No,
who
it's
covers
not.
it specifically.
The reason I ask is because that's where, if you look at the Fed rate dichotomy with what the market is expecting, right? The Fed's not going to potentially, and I'm not a Fed watcher, but the Fed's not going to necessarily reduce rates if the oil prices is going to be there at a particular level, because that kind of feeds into inflation.
That's very true. And as I said, I think that's a fair point. Hence why, inflation is so sticky at the moment. And I think that's why they've been so cautious in watching that. But of course, if we see core inflation remain sticky, if the US avoids that hard landing and starts to motor again, we'll see how they behave. But I think, I think once inflation is more under control, if that does happen, and I think is more a matter of time, then we will see the Fed obviously loosen rates. But I think we've already seen quite clearly that sort of the cautious stance they've maintained, and I think they're in no rush to do so as well. I think that partially answered your question, but only partially.
All right. So with this, we conclude this session. Can we please have a round of applause for Mr. Newman?